So the specific method we use for consolidation is called the acquisition method. In general, when control is obtained, we call it business combination is established. And then when business combination is established, we need to consolidate financial statements. And then consolidation has a lot of the advantages. For example, it will provide more meaningful information than separate statement. And it more fairly presents the activities of the consolidated companies. And then all of this can be done with both of the parent and the subsidiary still remain their separate legal identities. So let's look at the acquisition method. In general, we're going to talk more about it later, but in general, the acquisition method has 3 steps. The first step is to recognize and measure the consideration transferred for the acquired business and any non-controlling interest at its acquisition date fair value. So what does it mean? For example, firm A go out to acquire firm B. And then firm A is giving up something to acquire firm B. It can be in the form of cash. It can be in the form of stocks. Whatever A is giving up to acquire B, that is called consideration transferred. So we need to measure the consideration transferred for the acquired business at its acquisition date fair value. So whatever we give to acquire the acquiree, we need to measure its fair value at the acquisition date. So it can be in the form of cash, 1 million cash. The fair value of 1 million cash is 1 million. And then it can also be in the form of stocks. If it's in the form of stock, we need to measure its acquisition date fair value of those stocks. So the first step is to measure the fair value of the consideration transferred on the acquisition date. This is step 1. Step 2 is to recognize and measure the separately identified asset acquired, liability assumed at its acquisition date fair value. So we just talked about to measure whatever company A gave up to acquire company B. Now we need to measure company B's asset and liability at its acquisition date fair value. And then so what we get is company B, right? So we need to measure what we get at its fair value as well. And then the third step is to recognize goodwill or gain from a bargain purchase. So as you can see here, whatever the fair value of what A give may not be equal to the fair value of what A get. So the fair value of the consideration transferred may not be equal to the fair value of company B, of company B's identifiable asset and liabilities. And the difference between those, if consideration transferred is higher than the collective fair value of the net identifiable asset. So if what A give is more than the collective fair value of B's net identifiable asset, then we recognize it as goodwill. A is giving up more to acquire B, and then whatever A is giving up more, that is recorded as goodwill. And then if consideration transferred is smaller than the collective fair value of B's net identifiable asset, this difference we record it as gain on bargain purchase. So this is a gain. This is viewed as a gain for company A. And as you can see here, so for the acquisition method, there's a related key concept here, which is the fair value, because here everything is measured in fair value. So, what is fair value? The definition of fair value is, it is the price that would be received to sell an asset or paid to transfer a liability in an ordinary transaction between market participants at the measurement date. So this is basically, I guess the keyword here is in an ordinary transaction between market participants. And what is an ordinary transaction? So an alternate transaction is basically that I'm not putting a gun at your head to ask you to sell something to me or buy something from me. So this is an alternate transaction. And then how to determine fair value? We have three approaches to determine the fair value: market approach, income approach, and cost approach. What are the differences among these three approaches? For market approach, we use other market transactions involving similar assets or liabilities. And usually, when it is a tangible asset, such as marketable securities, which already have an established market, we can usually use market approach to measure the fair value of those assets. The second one, income approach, we use multi-period estimate of future cash flow. So this is basically DCF, discounted future cash flow. We project the future cash flow from the asset and discount it to the present. And usually we use it on intangible asset and acquired in-process R&D, which we don't have a readily established market for that. But we can still project the possible future cash flow coming from those assets. The third one is cost approach, which we use the current cost of replacing an asset with another comparable economic utility. And then this approach, we usually use it on tangible assets such as PP&E. So we talked about, this is just a very brief overview about the acquisition method. And so we just talked about previously, why do we need to know different kinds of business combination? Because it affects the way we consolidate. But the specific method we use in consolidation is the acquisition method. So in other words, the form of business combination would affect the way that the acquisition method is applied. So this is just a brief summary, and I'm going to talk about each of these situations in a minute. So what do we mean by the form of business combination would affect how the acquisition method is applied? If you still remember, when we talk about the form of business combination, we have four situations. And in the first two, there are dissolution takes place. So there's only either one or both of the original entities dissolve, and there's only one resulting entity, one surviving entity. And in 3 and 4, there's no dissolution, and still separate incorporation remain as a result of the business combination. So if it is in the situation of 1 and 2, when dissolution takes place, how do we acquire the acquisition method? In this situation, actually for the dissolving firm, all of the account balances are physically consolidated in the financial record of the survivor. So we permanently close out the dissolving firm's financial record at the acquisition date and move them all to the survivor firm's book. And so as a result of the business combination in the situation of 1 and 2, there's only one surviving firm in the end. So there's a business combination, the consolidation is done just one time at the time of the acquisition, and nothing needs to be done going forward. So, and then if it is in the situation of 3 and 4, where separate incorporation still remains as a result of the business combination. In these situations, so if it is firm A go out and acquire B, both A and B survive after the acquisition. Then both A and B still keep its own book. So no firm needs to close out its books. Both firms still keep its book. And then consolidation is done periodically on a consolidation worksheet. So this is what is happening. And both firm A and B, each firm continue to retain its own record. So A just keep doing its own book and B keep doing its own book after the business combination as if nothing happened. But at the end of the financial reporting period, both A and B needs to take its book and then do consolidation on consolidation worksheet. And then we're going to look at consolidation worksheet in a minute. But the last column of after doing consolidation on the consolidation worksheet, we're going to get a column of consolidated total numbers. And those consolidated numbers are what are reported to investors. So if you go out to pull out whatever firm's 10K report, you're going to see like their financial statements are probably most likely consolidated balance sheet, consolidated income statement. And what you see on those consolidated balance sheet, consolidated income statement, those are the consolidated numbers. Those are a result of consolidation of both firm A and firm B's book. But from A and from B, they are just keeping its original book. Nothing. You are not going to find those consolidated numbers directly from A's book or directly from B's book. Those numbers are taken from the consolidation worksheet. So we're going to like, if you cannot understand it now, that's okay. We're going to repeat those points again and again later in the semester and also in today's class.